Hey everyone, welcome back to the channel. Today is a big one, so get comfortable, grab your notes, and let's dive in. This is our first full mixed syllabus practice test for the Enrolled Agent exam. Part 1, Individual Taxation 2026-27. Unlike our previous domain-wise mini tests, this one pulls together 100 questions from across the entire Part 1 syllabus, covering all 6 major domains of the official exam blueprint. We're talking about Domain 1, Preliminary Work and Taxpayer Data. Things like residency status, filing requirements, and dependency rules. Domain 2, Income and Assets, covering wages, interest, dividends, retirement income, capital gains, and property transactions. Domain 3, Deductions and Credits, itemized deductions, the QBI deduction, and credits like the child tax credit and earned income tax credit. Domain 4, Taxation, topics like the alternative minimum tax, self employment tax, and additional Medicare tax. Domain 5, Advising the individual taxpayer, covering estate planning, retirement planning, innocent and injured spouse relief, and tax planning strategies. And finally, Domain 6, Specialized Returns for Individuals, estate tax, gift tax, and international information reporting like FBAR and Form 8938. So, this test is genuinely comprehensive. It's designed to give you a real snapshot of where you stand across the entire Part 1 syllabus, not just one section. This is going to be a long, thorough session, so take your time. As always, don't just sit back and listen. Pause after each question and its options. Work through it yourself and then check your answer against mine. With 100 questions covering the full breadth of the exam, this is honestly one of the best ways to genuinely test your overall exam readiness. Alright, let's stop talking and get started. Let's jump right into question 1. Alright, let's move to question 1. Cassandra, a resident of Denver, applies for a new credit card through Apex Airlines Visa. The card company offers 25,000 frequent flyer miles for spending $5,000 in the first 3 months. Cassandra makes over $5,000 in purchases between January and March 2025 and receives the 25,000 bonus miles. Under 2025 IRS rules, how should Cassandra handle the value of these frequent flyer miles on her tax return? A. Non-taxable promotional benefit. B. Taxable as miscellaneous income. C. Taxable as capital gains. D. Deductible as an itemized expense. The correct answer is A. Non-taxable promotional benefit. Under IRS guidance, frequent flyer miles awarded to a taxpayer as a promotional benefit for using a credit card are generally not considered taxable income. Because Cassandra received the 25,000 bonus miles as an incentive for making purchases with her Apex Airlines Visa card, the IRS does not require her to report the value of these miles as gross income on her 2025 tax return. Great, now let's move to our next question. Alright, let's move to question 2. For divorce or separation agreements executed after December 31st, 2018, how are alimony payments treated for federal income tax purposes? A. Deductible by the payer and taxable to the recipient. B. Non-deductible by the payer and non-taxable to the recipient. CT. Deductible by the payer and non-taxable to the recipient. Non-deductible by the payer and taxable to the recipient. The correct answer is B. Non-deductible by the payer and non-taxable to the recipient. The Tax Cuts and Jobs Act (TCJA) changed the treatment of alimony for divorce or separation agreements executed after December 31st, 2018. Under current law, alimony payments are non-deductible by the payer and not taxable to the recipient. Great. Now let's move to our next question. Alright, let's move to question 3. Hector, a resident of Tucson, Arizona, is unmarried and files as head of household. He claims his elderly mother, Esperanza, as a dependent. Esperanza is disabled, incapable of self care, and must attend an adult daycare facility while Hector works. Hector pays $11,000 for her daycare in 2025. Hector earns $80,000 in wages and has no other income. Under 2025 IRS rules, what is the maximum child and dependent care credit Hector can claim? A. $1,200, B. $600, C. $2,200, D. $3,000. The correct answer is B. $600. Under 2025 IRS rules, the Child and Dependent Care Credit allows a taxpayer to claim up to $3,000 in qualifying expenses for one qualifying individual. Because Esperanza is Hector's disabled dependent who is incapable of self care, she qualifies for this credit. Since Hector's adjusted gross income AGI exceeds $43,000, his applicable credit percentage is the minimum 20%. Therefore, his maximum allowable credit is calculated as $3,000 multiplied by 20%, resulting in a $600 credit, even though his actual daycare expenses were $11,000. Great. Now let's move to our next question. Alright, let's move to question 4. Clara, age 38, lives in Boise and has a rental property that nets $25,000 in passive income. She also works part time as a museum curator, earning $12,000 in wages. On weekends, she is self employed as a freelance graphic designer but had a net loss of $4,000 on her Schedule C business in 2025. What is the maximum amount Clara can contribute to her traditional IRA for the 2025 tax year? A. $12,000, B. $7,000, C. $4,000, D. $0. The correct answer is B. $7,000. Passive income from Clara's rental property does not qualify as compensation for IRA contribution purposes. While her net loss from self employment reduces her total earned income, it does not reduce the compensation used for IRA purposes, which remains the full $12,000 from her wages. Since Clara is under age 50, her maximum IRA contribution limit for the 2025 tax year is $7,000 and her qualifying compensation of $12,000 is sufficient to allow this full contribution. Great, now let's move to our next question. Alright, let's move to question 5. Marcus and Elara reside in Colorado, a state that recognizes common law marriage. They never obtained a marriage license or had a formal ceremony, but they share a last name, own property together, and introduce each other as spouses to their community. Under Colorado law, their actions establish a valid common law marriage. For their 2025 federal tax return, which filing status may they use? A. Single, B. Head of household, C. Married filing jointly, D. Qualifying surviving spouse. The correct answer is C. Married filing jointly. For federal tax purposes, the IRS recognizes common law marriages if they are valid under the laws of the state where the taxpayers reside. Because Marcus and Elara established a valid common law marriage in Colorado by holding themselves out to the public as a married couple, they are considered legally married for federal tax law purposes. Therefore, they must file using either the married filing jointly or married filing separately status, and they are ineligible to file as single. Great. Now let's move to our next question. Alright, let's move to question 6. Stefan resides in New York. On his 2024 federal tax return, he claimed the standard deduction. In 2025, he received an $850 refund of his 2024 New York State income taxes due to an overpayment. Under 2025 IRS rules, how much of this state tax refund must Stefan include in his 2025 federal gross income? A. The full $850. B. $0. C. Half of the refund. D. Up to $600. The correct answer is B. $0. Under the IRS tax benefit rule, a state or local income tax refund is only taxable to the extent the taxpayer received a tax benefit from deducting the taxes in the prior year. Because Stefan claimed the standard deduction on his 2024 federal tax return, he did not itemize his deductions and therefore received no federal tax benefit from overpaying his state income taxes. Consequently, the entire $850 state tax refund he received in 2025 is not taxable and does not need to be included in his 2025 federal gross income. Great. Now let's move to our next question. Alright, let's move to question 7. Rosalind, a 22-year-old US citizen, frequently visits her extended family in Italy. To save money for an upcoming study abroad program in Rome, she opened an Italian bank account. The highest balance in this account during 2025 was $15,000. Rosalind is supported by her parents, does not work, and has no gross income requiring her to file a federal income tax return. Under 2025 FinCEN and IRS rules, what is Rosalind's filing obligation regarding this foreign account? A. File an FBAR. B. File Form 1040NR. C. File Form 8938 only. D. No filing required. The correct answer is A. File an FBAR. Under FinCEN and IRS rules, a US person must file an FBAR, FinCEN Form 114, if they have a financial interest in or signature authority over one or more foreign financial accounts and the aggregate value of those accounts exceeded $10,000 at any time during the calendar year. The FBAR filing requirement is completely independent of the federal income tax return filing requirement. Even though Rosalind has no taxable income and is not required to file a Form 1040, her Italian bank account balance exceeded the $10,000 threshold in 2025, which mandates that she file an FBAR. Great. Now let's move to our next question. Alright, let's move to question 8. What is the tax rate for the additional Medicare tax and on which type of income is it imposed? A. 3.8% on net investment income. B. 0.9% on net investment income. C. 3.8% on earned income. D. 0.9% on earned income. The correct answer is D. 0.9% on earned income. The additional Medicare tax is imposed at a rate of 0.9% on an individual's earned income, such as wages, compensation, and self employment income, that exceeds certain threshold amounts based on filing status. Great. Now let's move to our next question. Alright, let's move to question 9. What is the maximum federal estate tax exemption amount for an individual decedent dying in 2025? A. $13.61 million. B. $13.99 million. C. $12.92 million. D. $10 million. The correct answer is B. $13.99 million. For the 2025 tax year, the federal estate tax exemption amount for an individual decedent is $13.99 million, adjusted for inflation from prior years. Great, now let's move to our next question. Alright, let's move to question 10. Beatrice is a self employed antique dealer in Boston who owns her own shop. On November 15th, 2025, she sells a vintage table for $15,000 and properly reports this income on her 2025 Schedule C. On February 10th, 2026, the customer discovers the table has severe undisclosed structural damage and returns it, demanding a full refund. Beatrice promptly refunds the $15,000 to the customer. Under IRS rules, how should Beatrice handle this repayment on her 2026 tax return? A. Deduct it as a business expense on Schedule C. B. File an amended 2025 tax return to remove the income. C. Claim a non-refundable tax credit against her 2026 income. D. Claim it as an itemized deduction on Schedule A. The correct answer is A. Deduct it as a business expense on Schedule C. Under IRS rules, if a self employed individual repays an amount that was previously included in their gross business income, the repayment is generally treated as a current year business expense. Because the $15,000 repayment relates directly to Beatrice's trade or business, she should deduct the amount as a business expense on her 2026 Schedule C in the year the repayment was made. She is not required to amend her 2025 tax return. Great. Now let's move to our next question. Alright, let's move to question 11. Which of the following is considered real property for tax purposes? A. Vehicles. B. Patents. C. Buildings. D. Livestock. The correct answer is C. Buildings. Real property refers to real estate, which includes land and anything permanently attached to it, such as buildings, farmland, and residential homes. Vehicles, patents, and livestock are classified as personal property. Great. Now let's move to our next question. Alright, let's move to question 12. Penelope, a new client in Austin, seeks help from Vincent, an enrolled agent, to prepare her 2024 taxes during the 2025 tax season. Before discussing her tax situation, Vincent asks Penelope to provide a picture ID and a copy of her social security card. He then carefully reviews her prior year's return and current tax documents to ensure accuracy. Under IRS best practices, what is the primary reason Vincent must request this documentation? A. To increase the preparation fee. B. To file an amended return. C. To verify taxpayer identity. D. To claim the child tax credit. The correct answer is C. To verify taxpayer identity. Under IRS guidelines, tax return preparers, including enrolled agents, must exercise due diligence to prevent tax related identity theft and fraud. Requesting a picture ID and a social security card or ITIN is a standard best practice required to verify the identity of the taxpayer before preparing and filing a return. This ensures that the preparer is accurately matching the client to their tax records and helps protect both the client and the preparer from potential identity theft schemes. Great. Now let's move to our next question. Alright, let's move to question 13. Tasha, age 45, resides in a FEMA declared disaster area in Louisiana. After her home was severely damaged, she took a $15,000 qualified disaster distribution from her traditional IRA in October 2024. She elected to report the entire distribution as income on her 2024 tax return. On March 15th, 2025, she decides to repay the $15,000 back into her IRA. Under 2025 IRS rules, how must Tasha report this repayment to reduce her previously recognized income? A. File Form 8915F with a 2024 Form 1040X. B. Deduct the repayment on her 2025 Schedule A. C. File Form 5329 with her 2025 Form 1040. D. Exclude the repayment as a 2025 gift. The correct answer is A. File Form 8915F with a 2024 Form 1040X. Under IRS rules, a taxpayer who receives a qualified disaster distribution from a retirement plan and includes it in their gross income can repay the distribution within 3 years of the day after the date of the distribution. If the taxpayer included the income in a prior year's tax return, they must file an amended return, Form 1040X, for that year to claim the repayment and reduce the previously reported income. Tasha must attach Form 8915F, Qualified Disaster Retirement Plan Distributions and Repayments, to her amended 2024 tax return to reflect the $15,000 repayment. Great. Now let's move to our next question. Alright, let's move to question 14. Eleanor and Thomas are married, live in Austin, and file a joint tax return. Both are high school teachers. During the 2025 tax year, Eleanor spent $750 out of pocket on qualifying classroom supplies, while Thomas spent $250 on qualifying classroom supplies. Under 2025 IRS rules, what is the maximum total educator expense deduction they can claim on their joint return? A. $300, B. $550, C. $600, D. $1,000. The correct answer is B. $550. Under IRS rules, eligible educators can deduct up to $300 of unreimbursed qualifying classroom expenses per year. If both spouses are eligible educators and file a joint return, the maximum deduction is $600, but it is strictly limited to $300 per individual spouse. Because Eleanor spent $750, her deduction is capped at $300. Thomas spent $250, so he can deduct his full amount. Therefore, their total maximum educator expense deduction on their 2025 joint tax return is $550, $300 plus $250. Great. Now let's move to our next question. Alright, let's move to question 15. What is the maximum IRA contribution limit for an individual under age 50 for the 2025 tax year? A $6,500, B $7,000, C $7,500, D $8,000. The correct answer is B $7,000. For the 2025 tax year, the maximum contribution limit to a traditional or Roth IRA for an individual under age 50 is $7,000. Great, now let's move to our next question. Alright, let's move to question 16. Cassius, age 68, sold a commercial warehouse in Portland, Oregon on March 1st, 2025 for $200,000. His adjusted basis in the property was $150,000. He died on March 10th, 2025 before receiving the payment from the buyer. The $200,000 is subsequently paid to his sole beneficiary and daughter, Fiona. Under 2025 IRS rules, how is the $50,000 gain from the sale of the warehouse treated? A. Fiona receives a step up in basis. B. Fiona reports it as IRD on her return. C. Cassius's estate excludes the gain entirely. D. The gain is reported on Form 1041 only. The correct answer is B. Fiona reports it as IRD on her return. Under IRS rules, when a taxpayer sells an asset but dies before receiving the payment, the gain is considered income in respect of a decedent, IRD. Because Cassius completed the sale before his death, there is no asset remaining in his estate to receive a step up in basis. Consequently, his beneficiary, Fiona, must report the $50,000 gain on her own individual tax return. The income retains the same character it would have had for Cassius, meaning Fiona will report it as a long term capital gain. Great. Now let's move to our next question. Alright, let's move to question 17. For federal tax purposes, a taxpayer's marital status for the entire tax year is generally determined on which date? A. January 1st, B. December 31st, C. The last day of the tax quarter, D. April 15th. The correct answer is B. December 31st. In general, a taxpayer's marital status on the last day of the year, December 31st, determines their marital status for the entire year for federal tax purposes. Great. Now let's move to our next question. Alright, let's move to question 18. Damien, a freelance photographer in Minneapolis, estimated his 2025 income when enrolling in a marketplace health plan and received advance premium tax credit PTC payments. His business did exceptionally well in 2025, resulting in an actual income that exceeds 400% of the federal poverty line, entirely disqualifying him from the PTC. He must reconcile the advance payments and realizes he received $3,500 in excess advance PTC. Under 2025 IRS rules, how must Damien handle this excess amount? A. Forgive the $3,500 due to high income. B. Claim a deduction for the $3,500 on Schedule C. C. Repay the full $3,500 using Form 8962. D. Carry forward the $3,500 to the next tax year. The correct answer is C. Repay the full $3,500 using Form 8962. Under the Inflation Reduction Act, taxpayers with household income exceeding 400% of the federal poverty line for the 2025 tax year are not subject to repayment caps for excess advance premium tax credit PTC payments. Because Damien's actual income exceeded this threshold and disqualified him from the PTC, he must use Form 8962 premium tax credit to reconcile his advance payments. As a result, the entire $3,500 excess amount must be repaid by adding it to his overall tax liability on his 2025 federal tax return. Great. Now let's move to our next question. Alright, let's move to question 19. What is the minimum holding period required for an asset to be considered long term for capital gains tax purposes? A. 6 months or less. B. More than 6 months. C. 1 year or less. D. More than 1 year, at least a year and a day. The correct answer is D. More than 1 year, at least a year and a day. To be considered long term, a capital asset must be held for more than 1 year, which means at least a year and a day. The holding period begins the day after the property is acquired and ends on the day it is sold. Great. Now let's move to our next question. Alright, let's move to question 20. Sergio, a graphic designer in Miami, earns a taxable salary of $95,000 in 2025. He also receives $12,000 in interest from municipal bonds. Under 2025 IRS rules, how should Sergio handle the municipal bond interest on his federal tax return? A. Fully taxable at the federal level. B. Tax exempt but must be reported. C. Taxable only above $10,000. D. Excluded from the return entirely. The correct answer is B. Tax exempt but must be reported. Under IRS rules, interest earned on state and local municipal bonds is generally exempt from federal income tax. However, taxpayers are still required to report this tax exempt interest on their federal tax return, specifically on Form 1040. Even though the interest is reported, it is not included in the calculation of the taxpayer's adjusted gross income or taxable income, keeping it federally tax free. Great. Now let's move to our next question. Alright, let's move to question 21. Under a pre 2019 divorce decree, if alimony payments are subject to reduction based on a contingency relating to a child, how is the amount subject to reduction treated for tax purposes? A. It is treated as a property settlement. B. It is treated as child support. C. It is treated as deductible alimony. D. It is treated as a non taxable gift. The correct answer is B. It is treated as child support. If an alimony payment is subject to reduction based on a contingency relating to a child, such as the child reaching a certain age, marrying, or going to college, the amount subject to the reduction is treated as child support, not alimony, for federal tax purposes. Child support is non-deductible by the payer and non-taxable to the recipient. Great. Now let's move to our next question. Alright, let's move to question 22. Daphne purchased her primary residence in Charlotte, North Carolina on March 15th, 2022. She lived in the home continuously until February 10th, 2025, when she moved out and attempted to rent it. After failing to find a tenant, she decided against renting the property and sold the home at a gain on December 15th, 2025. Under 2025 IRS rules, is Daphne eligible to exclude the gain from the sale of her home? A. Yes, she meets the 2-year use test. B. No, she moved out before the sale. C. No, she attempted to rent the property. D. Yes, but only up to a maximum of $10,000. The correct answer is A. Yes, she meets the 2-year use test. Under IRC Section 121, a taxpayer can exclude gain from the sale of a principal residence if they owned and used the home as their main home for at least 2 years during the 5-year period immediately preceding the date of sale. Because Daphne lived in the home for nearly 3 years before moving out, she satisfies the 2-year ownership and use tests within the 5-year look back period. Her temporary absence and unsuccessful attempt to rent the property do not disqualify her from claiming the exclusion on her 2025 tax return. Great, now let's move to our next question. Alright, let's move to question 23. Arthur provides full financial support for his 20-year-old daughter, Ophelia, who lived with him in Phoenix for all of 2025 and had no income. On December 28th, 2025, Ophelia married Julian, who earned $45,000 during the year. Ophelia and Julian elect to file a joint federal tax return for 2025. Under IRS dependency rules, can Arthur claim Ophelia as a dependent on his 2025 tax return? A. No, because they filed a joint return. B. Yes, because she is under 24. C. Yes, because she lived with him all year. D. Yes, because she had no personal income. The correct answer is A. No, because they filed a joint return. Under IRS rules, a taxpayer generally cannot claim a married person as a dependent if that individual files a joint return with their spouse. Because Ophelia and Julian filed a joint return for 2025 and Julian had substantial income, the joint return was not filed solely as a claim for refund. Therefore, Arthur is prohibited from claiming Ophelia as a dependent, regardless of the financial support he provided or her age. Great, now let's move to our next question. Alright, let's move to question 24. Which of the following tax credits is fully refundable? A. Child and dependent care credit. B. Credit for other dependents. C. Earned income tax credit. D. Lifetime learning credit. The correct answer is C. Earned income tax credit. The Earned Income Tax Credit EITC is a fully refundable tax credit. The Child and Dependent Care Credit, credit for other dependents, and Lifetime Learning Credit are non refundable. Great. Now let's move to our next question. Alright, let's move to question 25. Jolene is 16 years old, single, and legally blind. Her parents can claim her as a dependent for 2025. During the year, she earned $5,200 in wages from a part time job and received $1,500 in interest income from investments gifted by her grandmother. Jolene has no itemized deductions. Under 2025 IRS rules, what is Jolene's total standard deduction? A. $5,200, B. $7,600, C. $5,600, D. $17,750. The correct answer is B. $7,600. For 2025, a dependent's standard deduction is generally the greater of $1,350 or their earned income plus $400 up to the basic standard deduction for a single filer $15,750. Jolene's earned income is $5,200, so her base standard deduction is $5,600, $5,200 plus $400. Because she is legally blind, she is also entitled to an additional standard deduction of $2,000. Therefore, her total standard deduction is $7,600, $5,600 plus $2,000. Great. Now let's move to our next question. Alright, we've hit the quarter mark. 25 questions down, 75 to go. Great job staying focused so far. Just a quick note here. If you're finding that certain topics need more focused, repeated practice rather than just one pass through a mixed test like this, you can go with my ebook. It's organized chapter by chapter, so you can drill down on specific weak areas at your own pace. Link is in the description if that's ever useful for you. Alright, let's keep the momentum going. On to question 26. Alright, let's move to question 26. Percival is an unmarried physician residing in Seattle. For the 2025 tax year, he has regular taxable income of $650,000. He also invested in a profitable silver mine and claimed $50,000 in percentage depletion deductions from this investment on Schedule E. Under 2025 IRS Alternative Minimum Tax (AMT) rules, how must Percival handle this depletion deduction when calculating his alternative minimum taxable income (AMTIA)? Deduct the depletion a second time. B. Subtract the depletion from taxable income. C. Add the depletion back to taxable income. D. Exclude the depletion from AMTI entirely. The correct answer is C. Add the depletion back to taxable income. Under IRS rules for the alternative minimum tax (AMT), certain deductions allowed under the regular tax system are classified as tax preference items and must be added back to a taxpayer's regular taxable income to determine their alternative minimum taxable income (AMTI). Percentage depletion deductions claimed for mineral properties such as a silver mine are considered tax preference items. Therefore, Percival must add the $50,000 depletion deduction back to his $650,000 regular taxable income, resulting in an AMTI of $700,000 for the 2025 tax year. Great, now let's move to our next question. Alright, let's move to question 27. Lorenzo, a resident of Nashville, purchases a new delivery van for his business in 2025 for $28,000. He pays $2,240 in state sales tax on the vehicle. He also pays a delivery charge of $350 to have the van shipped from a dealership in another state. Under 2025 IRS rules, what is Lorenzo's basis in the vehicle? A. $28,350. B. $30,240. C. $28,000. D. $30,590. The correct answer is D. $30,590. Under IRS rules, the basis of an asset includes the purchase price plus any additional cost required to acquire the asset and place it in service, such as sales tax and delivery charges. Because Lorenzo paid $28,000 for the van, $2,240 in sales tax, and $350 for delivery, his total cost basis in the vehicle is $30,590. $28,000 plus $2,240 plus $350. Great. Now let's move to our next question. Alright, let's move to question 28. Felix, a resident of Miami, had $15,000 of gambling winnings and $22,000 of gambling losses at local casinos during the 2025 tax year. How should Felix report these amounts on his 2025 individual tax return? A. Report $15,000 as income and deduct $22,000 as an adjustment to income. B. Report $0 net gambling income on Form 1040 and do not itemize. C. Report $15,000 as income and deduct up to $15,000 on Schedule AD. Report $15,000 as income and deduct $22,000 on Schedule A. The correct answer is C. Report $15,000 as income and deduct up to $15,000 on Schedule A. Felix must report the full $15,000 of gambling winnings as gross income on his 2025 tax return. To claim a deduction for his gambling losses, he must itemize his deductions on Schedule A. The IRS limits the deductible amount of gambling losses to the amount of gambling winnings reported. Since his $22,000 in losses exceeds his $15,000 in winnings, his deduction is capped at $15,000. If Felix chooses not to itemize, he cannot deduct any of his gambling losses. Great. Now let's move to our next question. Alright, let's move to question 29. What is the 2025 Social Security wage base limit for the FICA tax? A. $168,600. B. $176,100. C. $160,200. D. $137,700. The correct answer is B. $176,100. For the 2025 tax year, the Social Security wage base limit, which is the maximum amount of earnings subject to the Social Security tax, is $176,100. Great. Now let's move to our next question. Alright, let's move to question 30. Elena, an enrolled agent in Seattle, reviewed her new client Julian's 2023 self-prepared tax return. She noticed he reported a cryptocurrency sale incorrectly, resulting in a significant understatement of tax. Elena informed Julian of the mistake and advised him to correct it. Julian agreed and asked Elena to prepare the amended return for a reasonable fee. Under IRS rules and Circular 230, what is Elena's appropriate course of action in this scenario for the 2025 tax season? A. File Form 8432 for penalty abatement. B. Prepare Form 1040X for a reasonable fee. C. Refuse service due to the client's prior mistake. D. Submit a new Form 1040 for 2025. The correct answer is B. Prepare Form 1040X for a reasonable fee. When an enrolled agent discovers a significant error on a previously filed tax return that resulted in an understatement of tax, Circular 230 requires the practitioner to promptly advise the client of the error. If the client agrees to correct it, the appropriate IRS form to amend a previously filed Form 1040 is Form 1040X, amended US individual income tax return. The enrolled agent is professionally permitted to prepare this amended return and charge a reasonable fee for the service. Great. Now let's move to our next question. Alright, let's move to question 31. Which IRS form is used by individual taxpayers to compute the alternative minimum tax AMT? A Form 6251, B Form 808001, C Form 8959, D Form 5405. The correct answer is A. Form 6251. Individual taxpayer compute the alternative minimum tax AMT on Form 6251. Alternative minimum tax individuals. Great, now let's move to our next question. Question 32. Dimitri and Sophia operate a successful crepe stand in Chicago as a general partnership. For the 2025 tax year, they obtain an Employer Identification Number EIN and file Form 1065 to report their business income. They each receive a Schedule K1 showing their equal share of the profits. How must Dimitri and Sophia report this income on their individual tax returns? A. Report on Form 1040, Schedule A as a miscellaneous itemized deduction. B. Report on Form 1040, Schedule C, subject to self-employment tax. C. Report on Form 1040, Schedule E, Part 2, exempt from self-employment tax. D. Report on Form 1040, Schedule E, Part 2, subject to self-employment tax. Take a few seconds to think about your answer. Pause the video if you need more time. The correct answer is D. Report on Form 1040, Schedule E, Part 2, subject to self-employment tax. General partnerships are required to file Form 1065 and issue Schedule K1s to the partners to report their distributive shares of income. Partners must report this pass-through income on their individual Form 1040 using Schedule E, Part 2. Because Dimitri and Sophia are general partners actively operating the crepe stand, their distributive share of the income is considered self-employment income and is therefore subject to self-employment tax. Great. Now let's move to our next question. Alright, let's move to question 33. Gregory owns a residential triplex in Nashville. He is not a real estate professional but manages the property himself and handles basic repairs for his three long-term tenants. Under 2025 IRS rules, how is Gregory's rental income treated for tax purposes? A. Schedule C subject to SE tax. B. Schedule E no SE tax. C. Schedule E subject to SE tax. D. Schedule A no SE tax. The correct answer is B. Schedule E no SE tax. Under IRS rules, rental income from real property is generally reported on Schedule E, Supplemental Income and Loss. Because Gregory is not a real estate professional and only provides basic maintenance and management for his long-term tenants, his rental income is not considered active business income. Therefore, the net rental income is subject to federal income tax, but it is not subject to self-employment SE tax. Great. Now let's move to our next question. Alright, let's move to question 34. Under section 121 of the Internal Revenue Code, what is the maximum amount of gain a married couple filing jointly can exclude from the sale of their primary residence? A. $250,000. B. $300,000, C $500,000, D $750,000. The correct answer is C $500,000. Under Section 121, a married couple filing a joint return can exclude up to $500,000 of gain from the sale of their primary residence, provided they meet the ownership and use tests and have not excluded gain from the sale of another home within the 2-year period prior to the current sale. Great, now let's move to our next question. Alright, let's move to question 35. Barrett and Lena both work full time and file a joint tax return in Baltimore, Maryland. They have 2 children, a 5-year-old daughter and a 3-year-old son. During 2025, they incur $5,500 in daycare expenses for their daughter and $4,800 for their son, totaling $10,300 for the year. Under 2025 IRS rules, what is the maximum amount of qualifying expenses Barrett and Lena can use to calculate their child and dependent care credit? A. $3,000, B. $6,000, C. $8,000, D. $10,300. The correct answer is B. $6,000. Under 2025 IRS rules, the Child and Dependent Care Credit limits the amount of eligible expenses that can be used to calculate the credit. For taxpayers with 2 or more qualifying individuals, the maximum amount of qualifying expenses is capped at $6,000 for the year. Therefore, even though Barrett and Lena incurred $10,300 in total daycare expenses, they can only use $6,000 as the basis to figure their child and dependent care credit on their 2025 tax return. Great! Now let's move to our next question. Question 36. Ramona, a resident of Atlanta, has 4 separate savings accounts at different financial institutions. During the 2025 tax year, she earned a total of $1,800 in interest income and received 4 Forms 1099 INT. Under 2025 IRS rules, what is Ramona required to do when filing her federal tax return? A. Attach all Forms 1099 INT to her return. B. File Schedule B listing each payer. C. Report only the total interest on Form 1040. D. Report the interest on Schedule C. The correct answer is B. File Schedule B listing each payer. Under IRS rules, if a taxpayer receives $1,500 or more in taxable interest income during the tax year, they must complete and file Schedule B, Form 1040, with their tax return. Because Ramona earned $1,800 in interest, she exceeds the $1,500 threshold. Therefore, she is required to file Schedule B and list the name of each financial institution, payer, and the exact amount of interest received from each bank. Great. Now let's move to our next question. Alright, let's move to question 37. Harrison, a 17-year-old resident of Denver, is claimed as a dependent by his parents. In 2025, he received $6,000 in interest income, $5,000 in qualified dividends, and $7,000 in capital gain distributions. His total unearned income is $18,000. Under 2025 IRS rules, how should Harrison's income be reported? A. Parents report it on Form 808014. B. Harrison files Form 1040 with Form 806015. C. Harrison files Form 1040 ES. D. Parents report it on Schedule B. The correct answer is B. Harrison files Form 1040 with Form 806015. Under IRS rules, a parent can elect to report a child's unearned income on their own tax return using Form 808014 only if the child's gross income is less than $13,000 for the 2025 tax year and consists solely of interest, dividends, and capital gain distributions. Because Harrison's total unearned income is $18,000, which exceeds the $13,000 threshold, his parents cannot make the Form 808014 election. Instead, Harrison must file his own Form 1040 and attach Form 806015 to calculate the kiddie tax on his unearned income. Great, now let's move to our next question. Alright, let's move to question 38. Under federal tax law, how are registered domestic partners required to file their federal income tax returns for the 2025 tax year? A as married filing jointly, B as head of household, C as single, D as qualifying surviving spouse. The correct answer is C as single. Federal law does not allow registered domestic partners RDPS to file a joint return. This rule also applies to civil unions. For federal tax purposes, they are considered unmarried and must file as single. Great, now let's move to our next question. Alright, let's move to question 39. What is the maximum annual gift tax exclusion amount for gifts made to a single individual in 2025? A $17,000, B $18,000, C $19,000, D $20,000. The correct answer is C $19,000. For the 2025 calendar year, the annual gift tax exclusion amount is $19,000 per dunny. This means an individual can give up to $19,000 to any number of individuals without incurring gift tax or requiring a gift tax return. Great. Now let's move to our next question. Question 40. Cornelius owns a small commercial plaza in Columbus, Ohio. One of his tenants, Lydia, needs to break her retail lease early because she is relocating for a new job. Cornelius agrees to terminate the lease if Lydia pays an early termination fee equal to 2 months' rent. Lydia agrees and pays Cornelius $5,500 to cancel the lease in 2025. Under 2025 IRS rules, how should Cornelius report this lease termination fee? A. Report as other income on Form 1040. B. Exclude from taxable income entirely. C. Report as capital gain on Schedule D. D. Report as rental income on Schedule E. The correct answer is D. Report as rental income on Schedule E. Under IRS rules, payments received by a landlord from a tenant to cancel or terminate a lease early are considered rental income. Because the $5,500 termination fee is directly related to the rental property agreement, Cornelius must report the payment as gross rental income on Schedule E, supplemental income and loss, for the 2025 tax year. Great. Now let's move to our next question. Alright, let's move to question 41. On which tax form is standard residential rental income and expenses generally reported? A. Schedule C, B. Schedule E, C. Schedule 1, D. Form 4835. The correct answer is B. Schedule E. Residential rental income and expenses are generally reported on Schedule E, Form 1040, Supplemental Income and Loss. The income is subject to income tax but not self-employment tax. Great. Now let's move to our next question. Question 42. What is the maximum IRA contribution limit for an individual age 50 or older for the 2025 tax year? A. $7,000, B. $7,500, C. $8,000, D. $8,500. The correct answer is C. $8,000. For the 2025 tax year, an individual who age 50 or older is eligible for a catch-up contribution of $1,000, bringing the maximum total IRA contribution limit to $8,000. Great, now let's move to our next question. Alright, let's move to question 43. Gideon is a hobbyist who collects vintage stamps, not a professional dealer. He purchased a rare 19th century stamp at a flea market in Boston 12 years ago for $75. In 2025, he sold the stamp to an enthusiast for $4,500. Under 2025 IRS rules, how is Gideon's gain from this sale treated on his federal tax return? A $4,425 short term ordinary gain. B $4,425 long term collectible gain. C $4,425 non taxable hobby gain. D $4,425 long term non collectible gain. The correct answer is B $4,425 long term collectible gain. Under IRS rules, collectibles such as stamps held for more than 1 year are subject to a maximum long term capital gains tax rate of 28%. Gideon's taxable gain is $4,425, calculated by subtracting his $75 basis from the $4,500 sale price. Because he held the stamp for over a year, the gain is classified as a long term capital gain from a collectible, which is fully taxable and reported on his federal tax return. Great, now let's move to our next question. Question 44. Paid tax preparers must complete Form 80-8067, Paid Preparers Due Diligence Checklist, when claiming which of the following credits? A. Foreign tax credit. B. Earned income tax credit. C. Residential clean energy credit. D. Savers credit. The correct answer is B. Earned income tax credit. Paid tax preparers must complete Form 80-8067, Paid Preparers Due Diligence Checklist, for any return claiming the Earned Income Tax Credit, the Child Tax Credit, the American Opportunity Tax Credit, and for determining head of household filing status. Great. Now let's move to our next question. Alright, let's move to question 45. Mateo's wallet was stolen while shopping in Denver. After filing a police report, he asks his enrolled agent, Samantha, how to protect himself from tax related identity theft. Samantha advises him to file an identity theft affidavit with the IRS and request an IP PIN. Mateo receives his IP PIN on January 15th, 2026. When Samantha prepares and e-files Mateo's 2025 tax return, she enters the IP PIN into her software. Under IRS rules, what is the requirement regarding the IP PIN? A. Prevents future IRS audits. B. Extends the tax filing deadline. C. Optional for e-filing returns. D. Required to e-file the return. The correct answer is D. Required to e-file the return. An identity protection PIN, IP PIN, is a 6-digit number assigned to eligible taxpayers to help prevent the misuse of their social security number on fraudulent federal income tax returns. Once an IP PIN is issued to a taxpayer, it must be used to validate their identity when filing their federal tax return, whether electronically or on paper. If a return is e-filed without the correct IP PIN, the IRS will reject it, preventing successful transmission and processing of the return. Great. Now let's move to our next question. Question 46. Dominic and Valeria are married US citizens residing in Dallas. They jointly own 2 foreign bank accounts in Costa Rica to manage expenses for a rental property. The aggregate value of these accounts exceeded $10,000 during the 2025 calendar year. Dominic files a single FBAR reporting both jointly owned accounts and completes the necessary authorization. Under 2025 FinCEN rules, what is Valeria's FBAR filing requirement? A. File a separate FBAR for her accounts. B. File Form 8938 instead of an FBAR. C. No separate FBAR is required. D. File Form 808065 to report the accounts. The correct answer is C. No separate FBAR is required. Under FinCEN rules, spouses who jointly own foreign financial accounts and reside in the same household may authorize one spouse to file a single FBAR on behalf of both. Because Dominic filed a single FBAR reporting all of their jointly owned foreign accounts in Costa Rica and included Valeria's authorization, she is not required to file a separate FBAR for the 2025 tax year. Great, now let's move to our next question. Alright, let's move to question 47. Wallace owns a residential rental property in Austin. In 2025, he signs a lease with his new tenant, Nadia. Upon signing the lease, Wallace receives $1,200 for the first month's in rent and a $1,000 refundable security deposit. How much gross rental income must Wallace report on his 2025 tax return from these payments? A. $1,200. B. $2,200. C. $1,000. D. $0. The correct answer is A. $1,200. Wallace must include the $1,200 advance rent payment in his gross rental income for the 2025 tax year. Under IRS rules, a refundable security deposit is not reported as income when it is received. It is only included in rental income if and when the tenant forfeits the deposit in the future, such as for failing to pay rent or causing property damage. Great, now let's move to our next question. Alright, let's move to question 48. Jasper, a resident of Denver, received Form 1099-S for the sale of a vacant investment lot, Form 1099-B for the sale of corporate stock, and Form 1099-DA for the sale of virtual currency during the 2025 tax year. Under 2025 IRS rules, where should Jasper initially report the details of these transactions to properly calculate his net capital gains or losses? A. Form 809049, B. Schedule C, C. Schedule ED, Form 407097. The correct answer is A. Form 809049. Under IRS rules, Form 809049, sales and other dispositions of capital assets is used to report the details of capital asset sales, such as investment real estate, stocks, and digital assets. For the 2025 tax year, transaction reported on Form 1099-S, Form 1099-B, and the newly introduced Form 1099-DA must be listed on Form 809049. The subtotals from Form 809049 are then transferred to Schedule D, where all capital gains and losses are summarized and netted for the year. Great, now let's move to our next question. Alright, let's move to question 49. With which federal agency must the FBAR, FinCEN Form 114, be filed? A. The Internal Revenue Service, IRS. B. The Department of Homeland Security, DHS. C. The Financial Crimes Enforcement Network, FinCEN. D. The Department of State. The correct answer is C. The Financial Crimes Enforcement Network, FinCEN. The FBAR is not filed with the IRS. It is filed directly with the Financial Crimes Enforcement Network, FinCEN, a division of the US Treasury Department, through the BSAE filing system. Great, now let's move to our next question. Alright, let's move to question 50. Rodrigo and Valentina are married and file a joint tax return in Miami. Rodrigo earns $230,000 in wages during 2025. Valentina does not work, but she sells an antique vase online for a $30,000 profit. Their joint modified adjusted gross income (MAGI) is $260,000. Under 2025 IRS rules, what is the amount of their net investment income tax? A. $1,140, B. $380, C. $0, D. $9,880. The correct answer is B. $380. Under IRS rules, the net investment income tax (NIIT) is a 3.8% tax on the lesser of a taxpayer's net investment income or the excess of their modified adjusted gross income (MAGI) over the statutory threshold for their filing status. For married filing jointly in 2025, the threshold is $250,000. Rodrigo and Valentina's MAGI is $260,000, which is $10,000 over the threshold. Because their net investment income, $30,000, is higher than the $10,000 excess, the NIIT applies to the $10,000. Therefore, their NIIT liability is $380, $10,000 times 3.8%. Great. Now let's move to our next question. And there we go. We're officially halfway through this test. Fantastic effort. This is not an easy session. So give yourself credit for sticking with it. Quick reminder as we push through the second half. If any of these topics have felt shaky and you want structured, chapter wise practice to really lock them in, my ebook covers every topic on part 1 in detail with full explanations. It's in the description whenever you need it. Alright, deep breath and let's get back into it. Question 51. Here we go. Alright, let's move to question 51. Janice, a 19-year-old single mother, lives in Boise with her parents and her 4-month-old son, Leo. During 2025, Janice worked part-time and earned $2,800, which was not enough to provide over half of the support for herself or Leo. Her parents provide the majority of the financial support for the household and plan to claim Janice as a dependent on their 2025 joint tax return. Under IRS rules, what is Janice's eligibility regarding claiming her son as a dependent? A. Janice can claim Leo instead. B. Leo must file his own return. C. Janice cannot claim dependents. D. Janice's parents cannot claim her. The correct answer is C. Janice cannot claim dependents. Under IRS rules, a taxpayer cannot claim any dependents if they themselves can be claimed as a dependent by another taxpayer. Because Janice meets the requirements to be claimed as a dependent by her parents for the 2025 tax year, she is prohibited from claiming her infant son, Leo, as a dependent on her own tax return. Great. Now let's move to our next question. Alright, let's move to question 52. Declan, a data analyst in Portland, earns $115,000 in wages during 2025. He also receives $3,200 in municipal bond interest, which is reported to him on Form 1099 INT under 2025 IRS rules. How is this income reported on his federal tax return? A. Report only the taxable wages. B. Exclude both the wages and interest. C. Report both but interest is not taxed. D. Report only the municipal bond interest. The correct answer is C. Report both, but interest is not taxed. Under IRS rules, interest earned on municipal bonds is generally exempt from federal income tax. However, taxpayers are still required to report the tax-exempt interest on their federal tax return, typically on Form 1040. Because Declan received the interest income, he must report both his taxable wages and the full amount of his municipal bond interest on his 2025 tax return, even though the bond interest will not be included in his taxable income calculation. Great. Now let's move to our next question. Alright, let's move to question 53. When preparing tax returns for clients, if a preparer discovers a serious error on a client's prior year tax return, what is the preparer required to do? A. Automatically file an amended return on the client's behalf. B. Inform the taxpayer of the mistake and explain the potential consequences. C. Report the error to the IRS without informing the taxpayer. Ignore the error since it is from a prior year. The correct answer is B. Inform the taxpayer of the mistake and explain the potential consequences. If an error or omission is discovered on a prior year return, the preparer is required by law to inform the taxpayer of the mistake and explain the potential consequences if it is not corrected. The preparer is not obligated to fix the error. However, great. Now let's move to our next question. Alright, let's move to question 54. Maxwell lives in San Diego with his wife and children. His employer offers a high deductible health plan that covers his entire family and contributes $2,000 to his HSA during 2025. Assuming Maxwell is under age 55 and has family coverage, what is the maximum amount Maxwell can contribute to his own HSA for the 2025 tax year? A. $6,550. B. $8,550. C. $4,300. D. $2,000. The correct answer is A. $6,550. Under 2025 IRS rules, the maximum health savings account HSA contribution limit for an individual with family coverage is $8,550. Employer contributions count toward this annual statutory limit. Because Maxwell's employer already contributed $2,000 to his HSA, Maxwell can contribute the remaining $6,550, $8,550 minus $2,000 to his account for the 2025 tax year. These personal contributions are deductible as an adjustment to gross income, and withdrawals are tax free if used for qualified medical expenses. Great, now let's move to our next question. Alright, let's move to question 55. For the 2025 tax year, what is the maximum deduction for qualified educator expenses per eligible educator? A. $250. B. $300. C. $350. D. $500. The correct answer is C. $350. For the 2025 tax year, the maximum deduction for qualified educator expenses is $350 per eligible educator. If both spouses are eligible educators and file jointly, the maximum deduction is $700, but it is limited to $350 per spouse. Great. Now let's move to our next question. Question 56. Silas is the sole proprietor of Apex Auto Repair in Austin. He reports his business income on Schedule C. In 2025, he sells several used hydraulic car lifts to upgrade his shop. He also sells personal shares of corporate stock at a profit as he is a casual investor. Under 2025 IRS rules, which forms should Silas use to report these sales? A. Schedule C and Schedule D-B. Form 189049 for both transactions. C. Form 407097 and Form 189049/Schedule D. D. Form 6252 and Schedule D. The correct answer is C. Form 407097 and Form 809049/Schedule D. Under IRS rules, the sale of business property, such as the used car lifts used in Silas's auto repair shop, must be reported on Form 407097, Sales of Business Property. Conversely, the sale of personal investment assets, like corporate stock by a casual investor, is reported as a capital transaction on Form 809049, with the totals flowing to Schedule D. Because Silas is selling both types of assets, he must use Form 407097 for the business equipment and Form 809049 with Schedule D for the stock. Great, now let's move to our next question. Alright, let's move to question 57. Leona is an unmarried taxpayer in Miami, age 42, and is legally blind. Her vision cannot be corrected with prescription lenses. Under 2025 IRS rules, what is the total standard deduction amount Leona is entitled to claim on her 2025 federal income tax return? A. $15,750, B. $17,750, C. $19,750, D. $21,750. The correct answer is B. $17,750. Under 2025 IRS rules, an unmarried taxpayer who is legally blind is entitled to the basic standard deduction for a single individual plus an additional standard deduction for blindness. For the 2025 tax year, the basic standard deduction for a single filer is $15,750 and the additional standard deduction for blindness is $2,000. Therefore, Leona's total standard deduction is $17,750, $15,750 plus $2,000. Great. Now let's move to our next question. Question 58. For the 2025 tax year, what is the basic standard deduction for a married couple filing jointly? A. $29,200, B. $30,000, C. $32,300, D. $36,400. The correct answer is B. $30,000. For the 2025 tax year, the basic standard deduction for a married couple filing jointly or a qualifying surviving spouse QSS is $30,000. This amount is adjusted annually for inflation. Great, now let's move to our next question. Alright, let's move to question 59. Kenji, a Japanese citizen and professional esports champion, enters the US in 2025 on a special visa to compete in a tournament in Seattle. He earns $500,000 in prize money and stays for 10 days before returning to Japan. Kenji is not eligible for a Social Security number SSN. To avoid automatic backup withholding on his income and properly file his taxes, what must Kenji do? A. Apply for an ITIN and file Form 1040 to report US source income. B. Apply for an ITIN and file Form 1040 NR to report US source income. C. File Form 1040 NR without an ITIN to report worldwide income. D. Apply for an SSN and file Form 1040 to report worldwide income. The correct answer is B. Apply for an ITIN and file Form 1040 NR to report US source income. Because Kenji is a non-resident alien who is not eligible for a social security number, he must apply for an individual taxpayer identification number ITIN to report his US earnings and avoid automatic backup withholding. As a non-resident alien, he is required to file Form 1040 NR, which only requires him to report income earned from US sources rather than his worldwide income. Great, now let's move to our next question. Alright, let's move to question 60. Genevieve has owned and lived in her home in Savannah, Georgia for the last 8 years. She marries Theodore on August 15th, 2025, and he moves into the home with her. Theodore dislikes the house and convinces Genevieve to sell it. They sell the home on November 20th, 2025, and realize a $420,000 gain. Genevieve meets the ownership and use tests, but Theodore does not meet the use test. Under 2025 IRS rules, what is the maximum gain exclusion they can claim on their 2025 tax return? A. $500,000, B. $250,000, C. $420,000, D. $0. The correct answer is B. $250,000. Under IRC Section 121, a married couple filing jointly can exclude up to $500,000 of gain from the sale of a principal residence only if both spouses meet the 2-year ownership and use tests during the 5-year period ending on the date of sale. Because Theodore did not live in the home for the required 2 years, he fails the use test. Therefore, Genevieve and Theodore are limited to the maximum exclusion available to a single individual, which is $250,000 for the 2025 tax year. The remaining $170,000 of the gain is taxable. Great. Now let's move to our next question. Question 61. At what minimum amount of taxable interest income is a taxpayer required to report the income on Schedule B, interest and ordinary dividends for the 2025 tax year? A. $500, B. $1,000, C. $1,500, D. $5,000. The correct answer is C. $1,500. If a taxpayer's taxable interest income exceeds $1,500 for the tax year, they must report the interest on Schedule B, interest and ordinary dividends. If the amount is $1,500 or less, it can be reported directly on Form 1040. Great. Now let's move to our next question. Alright, let's move to question 62. Sylvester, an investor in Omaha, purchased a commercial lot for $85,000 in 2025. Shortly after, an heir of the previous owner claimed the sale was invalid. To defend his ownership, Sylvester paid $12,500 in legal fees and successfully cleared the title. Under IRS rules, how are the legal fees treated and what is Sylvester's adjusted basis in the property? A. $85,000 basis, legal fees deducted. B. $97,500 basis, legal fees deducted. C. $97,500 basis, legal fees capitalized. D. $85,000 basis, legal fees capitalized. The correct answer is C. $97,500 basis, legal fees capitalized. Under IRS rules, legal fees incurred to defend or perfect title to property are not currently deductible as business expenses but must be capitalized and added to the property's basis. Because Sylvester paid $85,000 for the commercial lot and incurred $12,500 in non deductible legal fees to successfully defend his ownership, these costs are added to the original purchase price. This results in an adjusted basis of $97,500, $85,000 plus $12,500. Great. Now let's move to our next question. Alright, let's move to question 63. For the 2025 tax year, what is the basic standard deduction for a single taxpayer? A. $14,600, B. $15,000, C. $16,550, D. $21,900. The correct answer is B. $15,000. For the 2025 tax year, the basic standard deduction for a single taxpayer or a married taxpayer filing separately is $15,000. This amount is adjusted annually for inflation. Great. Now let's move to our next question. Question 64. Lionel and Mabel, a married couple filing jointly in San Francisco, incurred a significant alternative minimum tax AMT liability in 2024 after exercising incentive stock options. In 2025, they used Form 808001 to calculate an $85,000 minimum tax credit from these prior deferral items. Under 2025 IRS rules, how can Lionel and Mabel apply this AMT credit on their 2025 tax return? A. Carry the credit back to amend the 2023 return. B. Refund the entire credit as a cash payment. C. Apply it to reduce self-employment tax only. D. Reduce regular tax but not below tentative minimum tax. The correct answer is D. Reduce regular tax but not below tentative minimum tax. Under IRS rules, the alternative minimum tax credit calculated on Form 808001 allows taxpayers to recover AMT paid in prior years that was attributable to deferral items such as the exercise of incentive stock options. In 2025, Lionel and Mabel can use this $85,000 AMT credit to reduce their current year regular tax liability. However, the credit cannot reduce their regular tax below the tentative minimum tax for the year. Any portion of the credit that remains unused can be carried forward to future tax years. Great. Now let's move to our next question. Question 65. Liam and Harper, both 20 years old, are married and file a joint return in Portland. They provide all the financial support for Harper's 22-year-old stepbrother, Mason, who is a full-time student and lives with them for all of 2025. Mason is not disabled. Under IRS qualifying child rules, why are Liam and Harper unable to claim Mason as a qualifying child on their 2025 tax return? A. He is not permanently disabled. B. He is not a biological sibling. C. He is older than both taxpayers. D. He lacks a valid SSN. The correct answer is C. He is older than both taxpayers. Under IRS rules, to be a qualifying child, the individual must meet the age test. The child must be under age 19 or under age 24 if a full-time student. Crucially, the child must also be younger than the taxpayer or the taxpayer's spouse if filing jointly, unless the child is permanently and totally disabled. Because Mason is 22 years old and both Liam and Harper are only 20, he is older than the taxpayers and therefore fails the age test for a qualifying child. Great. Now let's move to our next question. Alright, let's move to question 66. To qualify for the Section 121 exclusion, a taxpayer must meet the ownership and use test. What is the minimum duration of ownership and use required during the 5-year period ending on the date of the sale? A. 1 year, B. 2 years, C. 3 years, D. 5 years. The correct answer is B. 2 years. To qualify for the Section 121 exclusion, a taxpayer must have owned and used the home as their primary residence for at least 2 years, 730 days, during the 5-year period ending on the date of the sale. The 2 years of ownership and use do not have to be continuous. Great. Now let's move to our next question. Alright, let's move to question 67. Fred, a 68-year-old unmarried resident of Savannah, Georgia, dies on October 12, 2025. His valid will names his daughter Lucy as the sole beneficiary and the executor of his estate. Lucy hires an enrolled agent and a probate attorney to assist with the court proceedings and tax filings. Under 2025 IRS rules, who is responsible for signing Fred's final form 1040? A. The enrolled agent preparing the return. B. The probate court judge overseeing the estate. C. Lucy as the executor. D. Fred's estate attorney. The correct answer is C. Lucy as the executor. Under IRS rules, the final individual income tax return, Form 1040, for a deceased taxpayer must be filed for the year of death, covering the period from January 1st up to the date of death. If a court appointed or will named executor or personal representative exists, that individual is legally responsible for filing the decedent's final tax return and must sign it in a fiduciary capacity. Because Lucy was named as the executor in Fred's will, she has the legal authority and obligation to sign his final 2025 Form 1040 on behalf of the estate. Great. Now let's move to our next question. Alright, let's move to question 68. Which of the following is not one of the three primary tests used to determine if a taxpayer can claim any individual as a dependent? A. Dependent taxpayer test. B. Joint return test. C. Gross income test. D. Citizenship or residency test. The correct answer is C. Gross income test. The three primary tests for determining if a taxpayer can claim any dependent are the dependent taxpayer test, the joint return test, and the citizenship or residency test. The gross income test is a specific requirement only for a qualifying relative, not a primary test for all dependents. Great. Now let's move to our next question. Alright, let's move to question 69. What is the aggregate value threshold that triggers the requirement to file the report of foreign bank and financial accounts FBAR A? $5,000 at any time during the calendar year. B. $10,000 at any time during the calendar year. C. $50,000 on the last day of the calendar year. D. $100,000 at any time during the calendar year. The correct answer is B. $10,000 at any time during the calendar year. A US person is required to file an FBAR if they had a financial interest in or signature authority over at least one financial account located outside the United States, and the aggregate value of all such foreign financial accounts exceeded $10,000 at any time during the calendar year. Great. Now let's move to our next question. Question 70. Parker and Crystal divorced in Denver, Colorado in 2016. Because their divorce decree was executed before 2019 and has not been modified, it is grandfathered under pre-TCJA rules. In 2025, Parker pays Crystal $1,800 per month in alimony and $1,200 per month in child support for their son. Under 2025 IRS rules, which of these payments is deductible by Parker and taxable to Crystal? A. Child support only. B. Both payments. C. Neither payment. D. Alimony only. The correct answer is D. Alimony only. Under IRS rules for divorce or separation instruments executed before December 31st, 2018, alimony payments are deductible by the payer and must be included in the gross income of the recipient, provided the decree has not been modified to adopt the post-TCJA rules. Because Parker and Crystal's 2016 decree is grandfathered, the $21,600 in annual alimony is deductible by Parker and taxable to Crystal. Child support is never taxable to the recipient nor deductible by the payer. So the $14,400 in annual child support has no federal tax impact for either party. Great. Now let's move to our next question. Alright, let's move to question 71. Roderick, an investor in Chicago, purchased 50 gold coins as investment on February 2nd, 2025 for $40 each plus $120 in sales tax. On October 15th, 2025, he sold all the coins to a dealer for $2,500. Under 2025 IRS rules, what is the character and amount of Roderick's gain? A. $500 long-term capital gain. B. $380 long-term capital gain. C. $500 short-term capital gain. D. $380 short-term capital gain. The correct answer is D. $380 short-term capital gain. Under IRS rules, a capital assets basis includes the purchase price plus any sales tax paid. Roderick's basis is $2,120. 50 coins times $40 plus $120. Because he sold the coins for $2,500, he has a realized gain of $380. $2,500 minus $2,120. Since he held the coins for less than 1 year, February to October, the gain is classified as a short-term capital gain, which is taxed at his ordinary income tax rate. Great, now let's move to our next question. Alright, let's move to question 72. Isidora, an immigrant residing in Houston, filed her 2025 tax return early on February 10th, 2026. Using her ITIN, she did not request a filing extension. On June 1st, 2026, her application for permanent residency was approved and she was issued a valid Social Security number SSN. Her 2025 income level would otherwise make her eligible to claim the Earned Income Tax Credit EITC. Under 2025 IRS rules, can Isidora amend her 2025 tax return to retroactively claim the EITC? A. Yes, but only up to $1,500. B. No, SSN not obtained by due date. C. Yes, the EITC is fully refundable. D. No, ITIN holders can never claim EITC. The correct answer is B. No, SSN not obtained by due date. Under the Protecting Americans from Tax Hikes (PATH) Act, a taxpayer and their spouse, if filing jointly, must have a valid Social Security number issued by the due date of the tax return, including extensions, to claim the Earned Income Tax Credit. Because Isidora filed her 2025 return early without an extension and did not receive her SSN until June 1st, 2026 after the April 15th, 2026 due date, the IRS prohibits her from retroactively claiming the EITC by amending her 2025 tax return. Great, now let's move to our next question. Alright, let's move to question 73. Reginald is a US citizen and the sole shareholder of Pacific Crest Logistics, Inc., a California C corporation. The corporation conducts business operations in Germany and maintains foreign bank accounts there. During 2025, the aggregate balance of these foreign accounts exceeded $10,000. Reginald has signature authority over all the company's foreign accounts. Under 2025 FinCEN and IRS rules, what are the FBAR filing requirements for Reginald and Pacific Crest Logistics, Inc.? A. Only Reginald must file. B. Both must file and FBAR. C. Only the corporation must file. D. Neither is required to file. The correct answer is B. Both must file an FBAR under the Bank Secrecy Act and FinCEN rules. A US person, which includes both a US citizen and a domestic corporation, must file an FBAR, FinCEN Form 114, if they have a financial interest in or signature authority over foreign financial accounts with an aggregate value exceeding $10,000 at any time during the calendar year. Because Pacific Crest Logistics, Inc. is a US entity that owns the foreign accounts, and Reginald is a US citizen with a financial interest as the sole shareholder plus signature authority over the accounts. both the corporation and Reginald are independently required to file an FBAR for the 2025 tax year. Great, now let's move to our next question. Question 74. LIS is a landlord in Seattle. On December 31st, 2025, a tenant drops a $1,200 rent check into LIS's designated payment logbox. LIS is out of town for the New Year holiday and does not physically retrieve or deposit the check until January 4th, 2026. Under IRS rules regarding constructive receipt, in which year must Elias report the rental income? A. 2026 because he deposited it then. B. Split evenly between 2025 and 2026. C. 2025 because it was available to him. D. 2026 because he took possession in January. The correct answer is C. 2025 because it was available to him. Under the IRS doctrine of constructive receipt, income is taxable in the year it is credited to a taxpayer's account or made readily available to them without substantial limitations or restrictions. Because the $1,200 rent check was available to Elias in his lockbox on December 31st, 2025, he is deemed to have constructive receipt of the funds at that time. Therefore, he must include the rental income on his 2025 tax return, even though he did not physically possess or deposit the check until 2026. Great. Now let's move to our next question. Alright, let's move to question 75. For the 2025 tax year, what is the maximum gross income a qualifying relative can have to meet the gross income test? A. $4,700, B. $5,050, C. $5,300, D. $5,400. The correct answer is C. $5,300. For the 2025 tax year, the deemed exemption amount used for the gross income test for a qualifying relative is $5,300. Noted. The 2024 amount was $5,050, but the question requires 2025 IRS rules. Great. Now let's move to our next question. Okay, we are in the home stretch now. 75 questions completed, just 25 more to go. You're doing great, don't lose focus now. And just one more mention. If you want to keep reinforcing these concepts after this test, my ebook is organized chapter wise with detailed explanations for every topic across part 1, perfect for targeted practice. Details are in the description below. Alright, let's finish strong. On to question 76. Question 76. Quentin is an Air Force reservist who lives in Chicago. He also has a full-time civilian job. His drill location is 150 miles away from his home where he reports for weekend meetings and annual training. Under 2025 IRS rules, what forms must Quentin use to deduct his unreimbursed travel expenses related to his reservist duties? A. Schedule AB, Schedule C, C Form 2106 and Schedule 1, D Form 3903. The correct answer is C Form 2106 and Schedule 1. Under IRS rules, National Guard and Military Reserve members who travel more than 100 miles away from home to perform their duties can deduct their unreimbursed travel expenses as an adjustment to gross income. Quentin must use Form 2106 to figure his deductible reservist travel expenses. The calculated amount is then transferred to Schedule 1, Form 1040, and claimed as an above the line adjustment to income, meaning he does not need to itemize deductions on Schedule A to claim this benefit. Great, now let's move to our next question. Question 77. Thaddeus rents out a duplex in Boise, Idaho. On December 18, 2025, his tenant Gemma pays 3 months of rent in advance in cash for January, February, and March 2026 because she is going on an extended trip to Australia. Under 2025 IRS rules, when must Thaddeus report this rental income? A. Entirely in 2025. B. Split between 2025 and 2026. C. Entirely in 2026. D. Excluded from gross income. The correct answer is A. Entirely in 2025. Under IRS rules, advance rent is taxable in the year it is received, regardless of the period it covers. Because Thaddeus received the cash payment for the 2026 rent in December 2025, he must include the entire advance payment as gross rental income on his 2025 tax return. Great! Now let's move to our next question. Question 78. Yusuf, a self employed consultant in Chicago, purchased health insurance through the marketplace for the first 5 months of 2025. On June 1st, 2025, he started a full time job that offered employer sponsored health coverage, so he immediately cancelled his marketplace plan. Under 2025 IRS rules, which tax forms will Yusuf receive to document his 2025 health coverage? A. Form 1095 A and Form 1095C. B. Form 1095B and Form 1095C. Form 1095A and Form 1095B. D. Form 1095C only. The correct answer is A. Form 1095A and Form 1095C. Under IRS rules, taxpayers receive specific information forms depending on the source of their health insurance coverage. Form 1095A is issued by the health insurance marketplace to individuals who enrolled in a qualified health plan through the marketplace. Form 1095C is issued by applicable large employers to employees who were offered employer sponsored health coverage. Because Yusuf had marketplace coverage for part of the year and employer sponsored coverage for the remainder of 2025, he will receive both Form 1095A and Form 1095C to document his coverage. Great. Now let's move to our next question. Alright, let's move to question 79. Sheldon and Vince, both unmarried, purchased a home together in Denver for $150,000. They lived in the home as roommates for 3 years. In early 2025, they each married their respective partners and decided to sell the home. On July 1st, 2025, the home sold for $300,000, resulting in a $150,000 gain, which they split equally. The title company issued a Form 1099-S to both Sheldon and Vince reporting the gross proceeds. How should Sheldon and Vince handle the sale on their 2025 individual tax returns? A. Omit the sale from their tax returns because the gain is fully excluded. B. Report the sale on Form 407097 and exclude up to $500,000 of gain per owner. C. Report the sale on Form 809049 and exclude up to $250,000 of gain per owner. D. Report the sale on Schedule B and pay ordinary income tax on the profit. The correct answer is C. Report the sale on Form 809049 and exclude up to $250,000 of gain per owner. Because Sheldon and Vince received a Form 1099-S, they must report the sale of the home on their individual tax returns using Form 809049. Since they both owned and used the home as their primary residence for at least 2 of the 5 years immediately preceding the sale, they meet the Section 121 ownership and use tests. As unmarried individuals filing their own returns, Each qualifies for the full $250,000 exclusion on their $75,000 share of the gain, making the profit non-taxable. Great. Now let's move to our next question. Question 80. Nolan and Caleb, a same-sex couple residing in Montana, are both US citizens. On July 4th, 2025, they traveled to Spain and were legally married in a civil ceremony. The United States recognizes foreign same sex marriages performed in Spain. When preparing their 2025 federal income tax return in 2026, which of the following filing statuses are they permitted to use? A. Married filing jointly or separately. B. Single only. C. Single or head of household. D. Head of household only. The correct answer is A. Married filing jointly or separately. Under federal tax law, the IRS recognizes marriages of same sex couples that are validly entered into in a foreign jurisdiction whose laws authorize such marriages. Because Nolan and Caleb were legally married in Spain during the 2025 tax year, they are considered legally married for US federal tax purposes. Consequently, they must use the married filing jointly or married filing separately filing status on their 2025 tax return, and neither individual is eligible to file as single. Great. Now let's move to our next question. Alright, let's move to question 81. When a taxpayer receives a non cash gift for opening a bank account with a deposit of $5,000 or more, what is the minimum value of the gift that must be reported as taxable interest income? A. $10. B. $20. C. $50. D. $100. The correct answer is B. $20. When a taxpayer receives a non cash gift for making a deposit or opening an account, the value of the gift must be reported as interest income. For deposits of $5,000 or more, gifts or services valued at more than $20 must be reported as taxable interest. Great. Now let's move to our next question. Question 82. Desmond, a combat veteran residing in Atlanta, is recovering from severe post traumatic stress disorder and experiences frequent seizures related to a service related head injury. His physician recommends that he obtain a service dog to assist with his medical conditions and provides a written prescription. Desmond obtains a trained service dog and incurs veterinary and food expenses for the animal. Under 2025 IRS rules, how are these expenses treated for tax purposes? A. Deductible medical expense. B. Non-deductible personal expense. C. Deductible business expense. D. Deductible charitable contribution. The correct answer is A. Deductible medical expense. Under IRS Publication 502, you can include in medical expenses the costs of buying, training, and maintaining a guide dog or other service animal to assist a visually or hearing impaired person or a person with other physical or mental disabilities. Because Desmond's physician recommended the service dog to help alleviate his PTSD and seizures, the costs associated with the dog's care, including veterinary bills and food, qualify as deductible medical expenses on his 2025 tax return, subject to the 7.5% adjusted gross income limitation. Great. Now let's move to our next question. Question 83. Shakira and Arturo are married and have a 5-year-old daughter named Chloe. Chloe attends a local daycare in Raleigh. Arturo works full time as an engineer. Shakira attended college full time from January 1st to May 31st, 2025. She was unemployed during the summer and did not attend school for the rest of the year, but Chloe continued to stay in daycare so Shakira could volunteer at a local library. For how many months of 2025 can Shakira and Arturo claim qualifying daycare expenses for the child and dependent care credit based on Shakira's status? A. 12 months, B. 5 months, C. 7 months, D. 0 months. The correct answer is B. 5 months. For the purposes of the child and dependent care credit, a spouse who is a full time student is treated as having deemed earned income for any month they are enrolled full time. Because Shakira attended school full time for 5 months, she meets the earned income requirement for those specific months, allowing the couple to claim the daycare expenses incurred during that period. The daycare expenses incurred during the remaining 7 months, when Shakira was neither working nor attending school, do not qualify for the credit. Great. Now let's move to our next question. Alright, let's move to question 84. Which of the following taxes was instituted to help fund the Affordable Care Act and applies to earned income? A. Net investment income tax. B. Additional Medicare tax. C. Additional Social Security tax. D. Net earned income tax. The correct answer is B. Additional Medicare tax. The Affordable Care Act instituted two taxes to help fund its provisions: the Net Investment Income Tax (NIIT) and the Additional Medicare tax. The Additional Medicare tax applies to earned income, while the NIIT applies to investment income. Great, now let's move to our next question. Question 85. Carson and Vivian lived together in Orlando, Florida until September 15th, 2025, when they officially separated. Carson filed a divorce petition on October 1st, 2025, and their divorce was legally finalized by the court on December 20th, 2025. The couple has no dependents. When preparing their 2025 federal income tax returns, what filing status must Carson and Vivian each use? A. Married filing separately. B. Single. C. Married filing jointly. Head of household. The correct answer is B. Single. Under IRS rules, a taxpayer's marital status for the entire tax year is determined by their status on the last day of the tax year, December 31st. If a divorce becomes final before the end of the tax year, the individuals are considered unmarried for that entire year. Because Carson and Vivian's divorce was legally finalized on December 20th, 2025, they are considered unmarried for 2025 and having no dependents must each file using the single filing status. Great, now let's move to our next question. Alright, let's move to question 86. Walker and Ember were married for 25 years until Ember's passing in August 2025. Walker is preparing their 2025 tax return and has not remarried. Which of the following correctly describes how Walker should file his 2025 taxes? A. File as single, reporting only his income from the date of Ember's death forward. B. File as married, filing separately, reporting only his own income for the year. C. File as married, filing jointly, including both incomes and signing as surviving spouse. D. File as qualifying surviving spouse, including both incomes for the entire year. The correct answer is C. File as married, filing jointly, including both incomes and signing as surviving spouse. For the tax year in which a spouse passes away, the surviving spouse is eligible to file a joint return, married filing jointly, if they have not remarried before the end of that year. By filing jointly, Walker can take advantage of a higher standard deduction and potentially lower tax rates. He is required to include both his and Eleanor's income on the return and may sign the return on behalf of his deceased wife as the surviving spouse. Great, now let's move to our next question. Alright, let's move to question 87. Which of the following individuals is eligible to claim the qualified educator expense deduction? A. A college professor. B. A homeschooling parent. C. A kindergarten teacher who works 900 hours a year. D. A high school student. The correct answer is C. A kindergarten teacher who works 900 hours a year. To qualify for the educate expense deduction, an individual must be a teacher, counselor, principal, or aide in a K 12 school for at least 900 hours during the school year. College instructors and homeschooling parents do not qualify. Great. Now let's move to our next question. Question 88. Sebastian was laid off from his manufacturing job in Tampa, Florida in 2025. He received $400 a week in unemployment compensation for 20 weeks. When he struggled to find new employment, he also began receiving SNAP, food stamp benefits to help feed his family. Under 2025 IRS rules, which of these benefits is considered taxable income on Sebastian's federal tax return? A. SNAP benefits. B. Both benefits. C. Unemployment compensation. D. Neither benefit. The correct answer is C. Unemployment compensation. Under IRS rules, unemployment compensation received from a state or the federal government is considered taxable income and must be reported on the recipient's federal income tax return. Conversely, government assistance programs designed to provide nutritional support, such as SNAP, food stamps, or WIC, offer benefits that are specifically excluded from gross income. Therefore, Sebastian must include the unemployment compensation he received in 2025 as taxable income, while his SNAP benefits remain entirely non taxable. Great, now let's move to our next question. Alright, let's move to question 89. Which of the following items is generally included in the original cost basis of an asset? A. Points paid to obtain a loan. B. Freight and charges and shipping fees. C. Routine maintenance and repairs. D. Personal property taxes. The correct answer is B. Freight and charges and shipping fees. The original cost basis of an asset generally includes the purchase price plus any ancillary costs required to acquire the asset, such as sales taxes, freight and charges, shipping fees, installation costs, and legal fees for transferring the asset. Routine maintenance, property taxes, and loan points are not added to the basis. Great. Now let's move to our next question. Question 90. Norman resides in a primary home located in Dallas, Texas. He also owns a vacation cabin in Aspen, Colorado that he only uses for weekend ski trips. In 2025, Norman sells the Aspen vacation cabin and realizes a $250,000 capital gain. Under 2025 IRS rules, how is the gain from the sale of the vacation cabin treated on Norman's federal tax return? A. Deferred under Section 1031. B. Fully taxable capital gain. C. Excluded up to $250,000. D. Partially excludable gain. The correct answer is B. Fully taxable capital gain. Under IRC Section 121, a taxpayer may exclude up to $250,000 or $500,000 for married filing jointly of gain from the sale of a principal residence, provided ownership and use tests are met. Because Norman's Aspen cabin is a secondary vacation home and not his primary residence, he cannot utilize the Section 121 exclusion. As a result, the entire $250,000 capital gain realized from the sale of the vacation cabin is fully taxable and must be reported on his 2025 federal income tax return. Great. Now let's move to our next question. Alright, let's move to question 91. Which of the following documents is preferable for a tax preparer to request to verify a taxpayer's identity for tax preparation? A notarized copy of the taxpayer's birth certificate. B. A utility bill showing the taxpayer's current address. C. A photo ID that includes the taxpayer's name and current address. D. A copy of the taxpayer's prior year tax return. The correct answer is C. A photo ID that includes the taxpayer's name and current address. In order to prevent fraudulent tax filings, it is important for tax preparers to request identification from taxpayers. Photo IDs are preferable and should include the taxpayer's name and current address. Great, now let's move to our next question. Question 92. Gaspar and Donna are married and file a joint tax return in Miami, Florida. Donna works part-time and does not receive health insurance through her employer. Gaspar was unemployed at the beginning of 2025 before starting a new job on May 15th, 2025. His employer sponsored health insurance started on June 1st, 2025. From January through May, the family purchased health insurance through the marketplace, assuming they meet all income guidelines. Under 2025 IRS rules, for what period can Gaspar and Donna claim the premium tax credit? A. Full year. B. 0 months. C. January to May only. D. June to December only. The correct answer is C. January to May only. Under IRS rules, the premium tax credit PTC is available for months. A taxpayer is covered by a qualified health plan purchased through the health insurance marketplace, provided they meet the eligibility requirements. If an individual gains access to employer sponsored coverage mid year, they are only eligible to claim the PTC for the months they were enrolled in the marketplace plan and did not have access to other affordable coverage. Because Gaspar and Donna had marketplace coverage from January through May 2025 before Gaspar's employer sponsored plan began. On June 1st, they can claim the PTC for those specific months. Great, now let's move to our next question. Alright, let's move to question 93. Under the constructive receipt doctrine, how is advance rent received by a cash basis taxpayer treated? A. It is taxed in the year the rent covers. B. It is taxed in the year it is received, regardless of the period covered. C. It is not taxable until the lease is fully completed. D. It is taxed only if the tenant does not request a refund. The correct answer is B. It is taxed in the year it is received, regardless of the period covered. Taxpayers must report rental income when it is constructively received. Advance rent is any amount received before the period it covers, and it must be included in income in the year received, regardless of the accounting method used. Great, now let's move to our next question. Question 94. Cordelia, age 48, and living in Charleston, South Carolina, was divorced in 2017. Under her court-ordered divorce decree, she receives $50,000 a year in taxable alimony, which is grandfathered under pre-TCJA rules. She has no other source of income. For the 2025 tax year, what is the maximum amount Cordelia is permitted to contribute to a traditional or Roth IRA? A. $0, B. $7,000, C. $8,000, D. $50,000. The correct answer is B. $7,000. Under IRS rules, taxable alimony received under a divorce decree executed before December 31st, 2018 is considered taxable compensation for the purpose of contributing to an IRA. Because Cordelia's 2017 divorce decree is grandfathered under pre-TCJA rules, her $50,000 of alimony qualifies as compensation since she is under age 50. The maximum IRA contribution limit for the 2025 tax year is $7,000. Therefore, she is permitted to contribute up to $7,000 to a traditional or Roth IRA grade. Now let's move to our next question. Alright, let's move to question 95. For the 2025 tax year, what is the maximum alternative minimum tax AMT exemption amount for a married couple filing jointly? A $88,100, B $133,300, C $137,000, D $156,700. The correct answer is C, $137,000. For the 2025 tax year, the alternative minimum tax AMT exemption amount for married taxpayers filing jointly and 130 surviving spouses. This amount is indexed for inflation. Great. Now let's move to our next question. Question 96. Phineas, an unmarried resident of Denver, dies on March 15, 2026. At the time of his death, he had not yet filed his 2025 tax return. He earned $115,000 in wages during 2025 and $18,000 in wages between January 1st, 2026 and his death. His sister Katie is the court appointed executor of his estate. Under IRS rules, which of Phineas's individual tax returns is Katie required to file? A. 2026 return only. B. 2025 and 2026 returns. C. 2025 return only. D. 2024 and 2025 returns. The correct answer is B. 2025 and 2026 returns. Under IRS rules, when a taxpayer dies, their executor is responsible for filing any unfiled prior year tax returns as well as the final individual income tax return for the year of death. Because Phineas had not yet filed his 2025 tax return before he died, Katie must file that return. Additionally, since he earned income in 2026 prior to his death on March 15th, Katie must also file his final 2026 tax return, covering the period from January 1st to the date of his death. Great, now let's move to our next question. Alright, let's move to question 97. For the 2025 tax year, what is the maximum amount of net capital loss that a single taxpayer can deduct against ordinary income? A. $1,500, B. $3,000, C. $5,000, D. $10,000. The correct answer is B. $3,000. A taxpayer can deduct up to $3,000 of net capital losses against ordinary income in a given tax year. For married taxpayers filing separately (MFS), the limit is $1,500. Great, now let's move to our next question. Question 98. Bartholomew is single and 68 years old, living in Seattle. During 2025, he received $16,000 in passive rental income from a residential duplex reported on Schedule E and $15,000 in Social Security benefits. He does not have a job or any other source of earned income. Under 2025 IRS rules, what is the maximum amount Bartholomew is permitted to contribute to a traditional or Roth IRA for the 2025 tax year? A. $0, B. $7,000, C. $8,000, D. $15,000. The correct answer is A, $0. Under IRS rules, a taxpayer must have taxable compensation such as wages, salaries, or self employment income to be eligible to contribute to a traditional or Roth IRA passive rental income reported on Schedule E and Social Security benefits do not qualify as taxable compensation for IRA contribution purposes. Because Bartholomew's income consists solely of passive rental income and social security benefits, he has no eligible compensation and therefore cannot contribute to an IRA for the 2025 tax year. Great. Now let's move to our next question. Alright, let's move to question 99. For the 2025 tax year, what is the maximum monthly limit for a qualified transportation fringe benefit for parking? A. $300, B. $315, C. $325, D. $330. The correct answer is C. $325. For the 2025 tax year, the maximum monthly limit for a qualified transportation fringe benefit for parking is $325. Great. Now let's move to our final question. Question 100. Claudio, a resident of Portland, passed away on October 15th, 2025, leaving unpaid medical bills from a prolonged illness. His daughter Victoria is the executor of his estate. On February 10th, 2026, Victoria pays Claudio's outstanding medical expenses of $35,000. How can these medical expenses be deducted for tax purposes? A. Deduct the expenses on Victoria's personal 2026 Form 1040B. Deduct the expenses only on the estate's federal estate tax return. Form 706. C. Elect to deduct the expenses on Claudio's 2025 final Form 1040. D. Deduct the expenses only on the estate's income tax return. Form 1041 for 2026. The correct answer is C. Elect to deduct the expenses on Claudio's 2025 final Form 1040. Because Victoria paid Claudio's outstanding medical bills within 1 year of his death, she, as the executor of his estate, can make a special election to deduct these expenses on Claudio's final 2025 individual income tax return. Form 1040. This rule is unique to deceased taxpayers and allows the executor to treat the expenses as if they were paid by the decedent, making them eligible for a deduction on the final return subject to the standard adjusted gross income limitations rather than deducting them on the estate's fiduciary returns. Great job finishing all 100 questions. And that's it. We made it through all 100 questions. Seriously, huge congratulations for sticking with this entire test from start to finish. This was a genuinely comprehensive session covering the full breadth of part 1 of the EA exam. And if you push through all of it, that says a lot about your commitment to this exam. Now I really want to hear from you. Drop your score out of 100 in the comments below. Be honest with yourself whether you scored high or found some serious gaps. This is exactly the kind of test that shows you where to focus your energy next. And just a reminder, if you want structured, chapter wise practice to work on specific weak areas you discovered today, my ebook covers every topic on part 1 in detail with full explanations. It's linked in the description whenever you're ready for it. If today's session helped you gauge your preparation, do hit that like button and make sure you're subscribed so you don't miss our upcoming practice tests. We've got more mixed tests and domain specific sessions coming your way, so stay tuned. Keep showing up, keep practicing. Every single test like this brings you one step closer to walking into that exam room with real confidence. Take care, and I'll see you in the next one.